Hello, everyone. My name is Eileen, and I'm going to help you understand your credit and give you some tips. This is our SBSB Aspire program, and you can find other topics on our page as well. Credit is the ability to borrow with the expectation that you'll repay later. It's really a tool for you that you'll likely use to purchase a home or a car, regular spending on a credit card, or maybe even finance your tuition. A lot of you listening have probably already utilized a line of credit for one or more of these reasons. And why does it matter? Establishing credit and building a strong score is important to your financial health because banks and other financial institutions will be more likely to lend to you on favorable terms. So how do you get an idea of where your credit stands? You can check your credit report. A credit report aggregates your past payment data on any credit you may have. Then it's made available to different credit card companies and financial institutions who would want this information if you apply for credit with them. You are entitled to one free online report from the three main credit bureaus. These include Experian, TransUnion, and Equifax. The good news here is that instead of checking once a year with just one bureau, you can strategize and check every 4 months. For example, if you start this in the new year, you can check Experian in January, and then TransUnion in May, and Equifax in September. And it can be really easy to forget about this, so it may be helpful to set a reminder in your phone every 4 months on a rotating basis. Checking your credit report regularly gives you the opportunity to ensure accuracy and can be a reality check on your behavior with your credit as well. All of the data that's in your credit report gets interpreted into a credit score. You're likely familiar with this term, but you might not know exactly how it's calculated or how it's broken down. The most important factor in your credit score is your payment history. Lenders want to see that you are likely to pay them on time. Late payments are the worst for your credit score, and they're the worst for your financial health because if you're not paying on time, you will end up incurring that interest rate that you see on your credit card that can be up to 20%. As long as you're paying on time, you will never pay that interest rate. Next is your debt to limit ratio. If you get very close to your limit of available credit every month, maybe let's say you're spending $900 out of the $1,000 that's made available to you, lenders will see that and think, oh wow, she's using every bit she can get her hands on. We're not confident that she'll pay us back. And personally, this is actually where I struggle because when you're first starting out, you don't get a very high limit. So it can be hard. But as you gradually increase your credit score, your limit will also increase, so it's not as much of an issue. However, if you're first starting out, something you can do to make this a little bit easier on yourself is maybe give yourself 1 or 2 regular expenses that you make every month, and you can just do those on your credit card to start out. Maybe groceries and gas, and that way you won't get too close to that limit to decrease your score. The next item is credit history and duration. The longer you've had credit, the better it is for your score. It shows you've been reliable in the past and that you likely will be in the future. A common misconception is that opening a new line of credit hurts your score, but really it just shortens that average duration of accounts, and it isn't bad in and of itself because sometimes you just need to open that new line of credit. So how does your credit score impact your ability to borrow? If you have nearly a perfect score, you are likely to get really good interest rates, and if you have a lower score, it's going to get higher and higher. So let's say you're ready to buy your first home in Virginia for $400,000. Congratulations, you make a 20% down payment, and you apply for a mortgage for $320,000 to be paid over 30 years. I used a loan savings calculator on myfico.com to get an idea of how that interest rate would affect your spending over the years and how your cash flow would be impacted. So with a perfect credit score, you will likely get offered close to a 3% interest rate, and as it gets worse and down to 620 maybe in that range, you'll get closer to 5%. When you get just a little bit off perfect, you are more likely to pay around an extra $14,000 in interest than you would if you had the perfect score. And then as it gets worse and worse, if you're in the 620 range that I just mentioned, you'll be closer to paying an extra $107,000 in interest, more than you would if you had that perfect score. So that's about $300 a month of extra interest. And just think of what you could do with that. You could really further your other financial goals if you weren't paying that unnecessary interest. Credit freeze. A credit freeze sounds scary, but it's actually meant to keep you safe. You'd want to freeze your credit in the wake of suspected identity theft or a data breach. That way, a hacker can't use your credit and you'll be protected from charges you didn't make, and your credit score will remain strong. Even if there's not a big, dangerous issue like this, you may still want to take advantage of this for other reasons, since it is free. For example, if you have multiple credit cards and want to concentrate your spending on just one card, maybe because you want to better monitor your spending, you can freeze the others instead of closing them. You'd want to do this to keep building your average credit duration to help out your credit score, like I mentioned before. So, in short, credit freezes are free and are meant to protect you. Just make sure to call your credit card company or use your app or website to unfreeze before using again. So now that you're a credit connoisseur, you'll be eager to open up a new credit card if you don't already have one. And you don't want to just apply for the first credit card you see an ad for. You want to shop around and always read through the terms carefully. You want to make sure any fees aren't outweighing the benefits. For example, a credit card with 1% cash back sounds great. If you spend $4,500 on that card, you'd get $45 back, and that's free money. But this card also has a $60 annual fee that you may not have noticed when you were reading over the terms. So you actually lose $15 here. And now that 1% cash back isn't as attractive as it seemed. Store credit cards are often guilty of these high annual fees, and lots of stores try to rope you in with a great sounding benefit, so be careful. And if you do find one that makes sense for you, make sure to treat it like a real credit card. It's easy to seem like it's basically an endless Starbucks or Old Navy gift card, but you'll still get hit with that interest rate if you're not paying on time, and it will negatively affect your score. Beyond just picking a credit card, you want to make sure you're ready for the responsibility that comes with it. You don't want to be spending more than you have in a checking account available to pay it off at the end of the month, so you don't end up maintaining a balance and paying that interest that I told you you do not have to pay. If you don't have any credit, but you want to start building it, consider a secured card where you deposit money that acts as collateral for the issuer. That way, they don't feel like they're taking on risk with someone who doesn't have any credit history and hasn't proven that they're going to pay back, because they have that collateral that they can take. You can also ask your parents to be set up as an authorized user on their cards. This helps you establish credit based on their data without taking out a personal line of credit on your own. But only do this if you're sure that your parents are paying their bills on time. And I wish I had asked my parents to do this, because it can be hard starting from nowhere, like I said before. The key points here, if you already have credit, are to stay on top of your payments and don't charge more than you can afford to pay back. If you don't have any credit yet, start with a secured card or ask to be added as an authorized user on your parents' cards. In either situation, always be aware of and in control of your own financial situation, and take advantage of the free credit reports. If you're sitting here and listening and thinking, man, I messed up, I already have this long-term loan at a high interest rate because my credit score was bad when I was first starting out. Well, not all hope is lost. As you improve your credit score, you can apply to refinance your loan and hopefully pay less in interest going forward. I hope that was helpful. I recommend that you check out and listen to the other topics covered in our Aspire program. Thanks for listening.